few things I am not. I'm not a cat.
Alright, hi everyone, I'm super excited about today's video because today we're going to talk about the return of the roaring kitten. Meaning today we're diving into a story that may be straight out of a financial thriller playbook. Imagine this, you've got this lone financial influencer, dormant for months, who suddenly resurfaces on Twitter. And as a result of just a few taps on his keyboard and a few clicks on his mouse, literally billions of dollars are moved on the stock market. This sounds like something straight out of a Hollywood movie, doesn't it? Well, this is no fiction, so let's dive into the story. Alright, so in this video we're going to talk about no other than Keith Gill. I think that's how you pronounce him. You might better know him under his alias Roaring Kitten, so the Roaring Kitten, who basically became an overnight sensation during the GameStop saga of 2021. And now after a month of silence, he's back in action. And we'll get to that in just a second. But let's first discuss who the Roaring Kitten actually is. So here's the short primer. So Keith Gill, as I said, better known by his online alias, the Roaring Kitten. Well, he gained prominence during the GameStop stock saga in early 2021 when he, a financial analyst and investor, played a significant role in the frenzy surrounding the stock of GameStop, ticker GME, through his posts and videos on Reddit and the Wall Street Bets subreddit forum. And of course also his YouTube channel. And arguably his analyses and his bullish stance on GameStop encouraged many other small investors, or maybe we should say small speculators, to buy shares of GameStop, contributing to the stock's meteoric rise in 2021. And to be fair, his actions drew both admiration but also criticism, and as a result he was subsequently called to testify before the Congress to clarify his role in the events surrounding the GameStop stock performance.
A few things I am not. I'm not a cat. I am not an institutional investor, nor am I a hedge fund. I do not have clients, and I do not provide personalized investment advice for fees or commissions.
Yeah, and in this video, I want to discuss the implications of the return of the Roaring Kitten for investors. And maybe we first need to define what an investor actually is, because my understanding is that there are different definitions of the term investor out there. So in my book, you are only an investor. You are only investing if you are aiming to buy something, so an asset, for less than it is actually worth. And if you're doing something else, if you are trying to speculate whether the price of a stock, for example, may go up or down based on non-fundamental factors, well, then you are not investing, you are speculating. Again, you are only investing if you have a clear understanding and a clear opinion on what an asset, in the case of stocks, what a company is actually worth. And you are only buying into the stock if you believe that the current price of that stock does not fully reflect the actual value of the underlying business. So if this is your understanding of investing, what are the implications of the Roaring Kitten being back? And maybe primarily the fact that there's this financial influencer out there. He's posting 2 or 3 tweets, and as a result, the stock of a multi-billion-dollar company is moved or influenced dramatically. The stock is up around 60% as of the time I'm recording this video. And I think at some point the total market capitalization of the stock went above 9 billion. So again, we are seeing a multi-billion-dollar move in the stock price. So again, what does this mean for actual investors? Well, I think there are 2 different takes on this. So arguably, on the one hand, this is bad because as investors, we are focused on fundamental factors, business performance, management decisions, customer behavior. And if stock prices are not moved by actual fundamentals, well, we have a problem because as an investor, you can only make money if the divergence that you have between the price a stock is trading at and the actual value, if that gap closes at some point. But if prices are driven by other non-fundamental factors, well, how are you going to make money? So I was reading this one tweet from a German investor. His name is Stefan Waldhauser. And he basically tweeted, what kind of investing world is it that we are living in where a financial influencer can move the value, I should say the price, of a company up by almost 100%. And he said, that's not the world I'm living in. So I guess that's one of the perspectives that you may want to adopt. However, I think there's also another perspective worth highlighting. So I would argue the fact that stock prices can move up up to 100%, even more. Who knows where GameStop closes today? If this is possible just because one financial influencer that many speculators admire sends out 2 tweets, or I think it was maybe 3 tweets, I think this is something that long-term focused investors should embrace. Because what we are seeing here is extreme volatility that is caused by non-fundamental factors. And as long-term value-focused investors, this is something we should embrace. We love volatility because only volatility can give us the opportunity to buy stocks when they are trading at prices that do not reflect the true value of the company. And it also allows us to sell investments once the price a company is trading at far exceeds the actual value of a business. I've tried to visualize this in different visualizations in the past. I've come up with the 70-20-10 rule, for example, that shows that over the short term, the driving factors of stock prices are completely different than the driving factors over the long term. So as long as over the long term, earnings growth, the development of shares outstanding, and valuation multiples are the key drivers of stock performance, I don't think you have to worry about the return of the roaring kitten. If anything, it highlights that stock markets and stock prices are not efficient, at least not all the time, which proves that investing, smart investing, intelligent investing as I call it, it works, but it requires that you actually understand what the intrinsic value of a company actually is and what the drivers of intrinsic value are. And I've highlighted this in many of my other videos before. So it's not only about the roaring kitten, it's about social media and the increasing importance of social media as a whole. I think the emergence of social media have made stocks more volatile, or at least they make them more volatile in small or short periods of time. And this is a good thing. On the other hand, you have this whole regulatory debate. Should one financial influencer be able to move billions of dollars in market value? Well, probably not. And there's something regulators have to do maybe. I'm not sure what kind of actions they would have to take here. I honestly don't know, but I guess that's one question that should be brought up. But again, this deserves its own video. And I guess that's it for today already. Let me know what you think of this situation. What do you think of the return of the roaring kitten? I'll talk to you soon.